Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Just over the last couple of months here, we are starting to see a record number of rating downgrades that are foreshadowing a bloodbath of bankruptcies over the next year. That's going to be the headline story today, but I'm also going to show you that we're seeing huge divergences between what the stock market is currently pricing in and what the bond market is pricing in. It's often said that bond yields are smart money and are much more accurate at pricing in risk in the market. And right now we're seeing a very significant spread between bonds and stocks. If you enjoyed this video, don't forget to smash the like button and of course subscribe to the channel if you are new here, if you're interested in these types of videos. And now without further ado, let's get right into it. So I want to begin by showing you this index here, the Bond Market Volatility Index, also called the MOVE Index. Now you can see ever since around June 2021, we've seen the bond market volatility rise significantly to levels not seen since 2008. And meanwhile, if we take a look at the stock market volatility, well, we've actually seen that move down over the past few months. Now you zoom out on this chart and you can see most of the time these two indices track each other pretty closely. When the bond market sees a potential risk in the market, you're going to see bond market volatility spike. When the stock market sees a risk, you're going to see the VIX spike. Those are moments where the stock market tends to move down. You can see here 2008, both the bond market volatility index and the VIX were spiking as the market was moving down. And you can see we've had that many times before, such as 2011 here, bond market volatility spiking. You can see here, for example, in 2011, you had the bond market volatility spike, the VIX spiking as well as the market was moving down, right? Most corrections happen that way. Same thing again in COVID, you had the bond market volatility spike, the VIX spike as the market was moving down. But now you can see we've had a very significant divergence between what the stock market here in orange is pricing in and what the bond market is pricing in. You can see clearly the MOVE index making higher highs as the VIX is making lower highs and lower lows. So let's zoom in a little bit more into this chart. You can see, first of all, look at the top of the market in 2021. This was the top here. In November 2021, look at where the VIX was. It was making new lows. It was being very complacent here with the VIX at around 16. Meanwhile, look at what the bond market volatility index was doing. It was trending higher leading up to the big top. So this was already telling you that the bond market was seeing concerns that the stock market was disregarding back here towards the end of 2021. Now, of course, it took a long time for that to play out, but I think you get the point here. And you actually saw the exact same thing happen in August of 2022. You again had the bond market volatility index make higher lows here and begin picking back up and turning back up here while the VIX was making lower lows. So if you look at where we are today, we are clearly seeing the bond market get a lot more concerned about macroeconomic risks than the stock market. Higher lows here on the bond market volatility index while the VIX is still trending down. And in fact, you can see here the VIX getting down to 15, which is the same level where the markets actually peaked back in late 2021. You had the VIX bottom at around 15, 16 here, which is exactly area where the VIX is at right now. So there is a lot of complacency in the market right now, volatility being extremely low. There's a lot of room for things to get worse here, right? This is how things work. You want to buy when the VIX is elevated. Look at this, COVID bottom, VIX hitting extremely elevated levels. That was one of the most beautiful buying opportunities in decades. But when the VIX is low, a lot of good news has been priced into the market. It's very difficult to be extremely optimistic on the stock market. So the question is, what does the bond market know here that the stock market doesn't? Can we actually answer that question and see, for example, what happened in August? Why was the bond market so much smarter than the stock market here in 2022, which was of course followed by a big move down in stocks leading up to that October low? Well, if you were following us back in October, you'll know that the Fed stepped in here with a very hawkish speech bringing down the market. They did that because inflation was running hot. You look at the core inflation rate in the United States back in August of 2022, well, it was running above 6%. Let me remind you that the Fed's inflation target is at 2%, so very far off from their target. So they have to have a very hawkish stance. They have to talk about continuing rate hikes until they see evidence that inflation is really coming down to their 2% target, which of course was not the case in August, and the bond market knew that. And in fact, it's still not the case. Inflation is still running at 5.6%. There's no signs of it really breaking down yet. And in fact, the US is not alone. You look at the core inflation rate in Europe, and it still continues to run hot. So by the looks of it, it seems like that it's still much too early for the Fed to begin easing monetary policy, bringing their interest rate back down, and try to fuel an economic boom. Because if they do that too early, they're going to stimulate inflation again, and it could be the 1970s all over again. At least the Federal Reserve is very adamant about avoiding this type of scenario. So perhaps that is what the MOVE index is seeing right now, that the stock market is completely disregarding, is that the Fed still has a lot of work to do in order to fight inflation. And you're going to see the VIX snap back to reality as it understands that the bond market is really seeing things right. Now you look at what the market is currently pricing in for the next few months. You can see the market expects the Federal Reserve to pause monetary policy in June of 2023 and keep interest rates at around 5%. For July 2023, the market expects that the Fed is going to keep rates at 5% as well. So pausing the rate hike cycle right up until September, where the market actually expects the Federal Reserve to begin cutting rates. So what is the scenario where the Federal Reserve actually does begin to cut rates in September of 2023, with core inflation still trending at 5.6%? Now, hypothetically, you can say, okay, in September, it could be that inflation will be at around 5%, maybe 4.5% if we really get an aggressive move down. But that is still very much away from the 2% target that the Federal Reserve has. If we take a look at the last time that core inflation was trending in around this zone here, between, let's say, 1983 and 1990, you look at where the Fed funds rate was at throughout this period, and it was actually between 10% during the very tight monetary policy periods and 7% when monetary policy was very loose. Right now, we're still only at a 5% federal funds rate. So what would it take for the Federal Reserve to begin cutting rates despite the fact that inflation is still in around this zone here? Well, I'm going to tell you exactly what. It's a hard landing scenario. They will only do that if a recession begins to play out very aggressively over the next few months. And in fact, the market expects that to happen by September of 2023. And the ratings downgrades that I mentioned at the beginning of the video that I'm going to show you right now are actually pointing to the fact that this is a plausible scenario and that this is really not too far off. By the way, if you're enjoying this episode, if you're learning something new, if you're finding it insightful, don't forget to smash the like button because that makes a massive difference. Now, this is a chart that shows you the number of credit downgrades that we've seen throughout 2023, and you can see that's been rising significantly. So companies like S&P Global are downgrading credit ratings of corporations around the world, and that's been accelerating throughout 2023. Now you can see typically you see that happen heading into recessions. 2001, 2002 big recession, you have downgrades surge leading up to the recession. 2009 here, you have downgrades surging leading up to the recession. So this really seems to be playing out right now. We're seeing credit downgrades happen right before us, and yet we really haven't seen defaults around the world play out yet. You can see in 2009 and 2020, you had recession, so defaults rose following these spikes in credit downgrades. But here over the last year in 2022, we actually saw a pretty low number of defaults. So we really haven't seen these ratings downgrades play out in the real economy. And you look at, for example, what the actual market is pricing in right now. You look at credit spreads. This is a measure of how much risk is being priced into the market right now. You can see credit spreads rise into recessions and actually spike during the recession. Same thing here in 2008, rising into the recession, spiking during the recession. Here, yes, we've had credit spreads begin to rise, but we haven't seen the spike yet. So this is really a very strange moment where the Fed is seeing a potential hard landing play out, where they would typically need to ease monetary policy very significantly. But if they choose to do that too early, they risk stimulating the economy too soon and reviving inflation before it even has the chance to break down. So these are really core aspects of our macro strategy at gameoftrades.net. We've positioned our model portfolio in a way that takes these risks into account. We have a lot of different uncorrelated assets that we think represent exceptional opportunities in the market right now, and we actively make updates on the price action, potential buy points, sell points on these assets, and really take you through the entire process of macro trading. So don't hesitate to click the link down below, start your free trial. Now, if you enjoyed this video, don't forget to smash the like button, of course, and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.